Welcome to your week in Forex from UFXBank. My name is Tammy, and today we will be joined by foreign exchange analyst Martin Smith. Volatility returned to the marketplace to usher in 2010. The new year kicked off with global equity markets rising while bond prices declined. Gold and oil have advanced as the greenback lost momentum. By Thursday, however, markets reversed their course. Let's take a closer look at these tendencies with Martin Smith. Welcome, Martin.
Hi, Tammy.
Let's begin by hearing your take as to what prompted the equity rally that we saw last week.
Well, it was the continued positive Chinese manufacturing data that led the way, of course, as it demonstrates that global demand is now back on the rise.
We expect that when equity prices go higher, that bond prices will go lower. But didn't you think that the drop in price was a little extreme?
Well, if the move to bond prices is merely a result of capital shifting from one market to the other, as you suggest, then yes, I'd agree. However, in this case, the bond sell-off was triggered by PIMCO's Bill Gross. Now, PIMCO is the world's largest bond fund. PIMCO's reducing their holdings of US and UK debt, suggesting yields on new securities will continue to rise.
Shouldn't that sentiment be positive for the dollar?
Well, if the Fed was actually raising rates, yes. However, PIMCO's position is simply that as borrowing increases in both the US and Great Britain, investors are going to demand greater yield to purchase the securities. Then, of course, we've got Fed Chairman Ben Bernanke, and he opened the week reiterating his stance that rates will remain low for an extended period of time. And that's basically why the dollar lost momentum.
As the dollar weakened, gold and oil continued to rise. Are we going to see the price continue to go higher for commodities?
I do believe gold will remain firm. I mean, demand is still present, and until a recovery is firmly underway and with little chance of a double dip, I think gold will remain bid. Oil, on the other hand, is benefiting from a weak dollar and seasonal demand. Now, in the long run, I anticipate oil will trade at elevated levels as global demand increases. However, I don't see near-term prices remaining continually above $80 a barrel, especially as we move into the spring.
So what was the catalyst behind the market reversals that we saw late last week?
Well, it started during the Acer session on Thursday, when China decided to raise the yield on some of their short-term bills.
If economic data, such as manufacturing that you've mentioned before, if it was positive, what would cause China's central banks to take such measures?
Well, China, in some respects, has been leading the economic recovery. However, they're also engaged in quantitative easing programs that they now want to constrain because they feel it may produce an asset bubble in their country. Well, for example, real estate prices have soared over the last 1.5 years.
Right. So looking ahead to this week that's coming up, what can our traders anticipate?
I think correlations are key at this juncture. Will positive US economic data be positive for the dollar and the stock market? Well, last week, that correlation once again turned negative, and as a result, traders went right back into high-yielding currencies like the Kiwi and the Aussie. The euro, pound, and yen still look weak from a technical standpoint. Therefore, if the equity to dollar correlation turns positive again, and the euro, pound, and yen break through near-term support, well, then I'd expect the Aussie and Kiwi to be amongst the big losers this week.
Well, thank you, Martin, for your valuable insights once again. Until next week, I'm Tammy, and be sure to visit us at UFXBank.com for simple, safe, and secure trading.